What if I told you that you could build a fortune by investing in one of the oldest and most reliable assets in the world? Sounds tempting, right? Well, it's true. Great insights on Warren Buffett, one of the greatest investors in the world. You will discover that and more. Are you curious about those secret weapons that millionaires and billionaires use to build their fortune? Ever wondered how some folks seem to effortlessly glide through life while their money multiplies on autopilot? Well, my friends, wonder no more. Because today, I will be revealing 5 life-changing assets that can ensure you'll never have to work again unless you absolutely want to. Here are 5 assets that make people rich and never work again. Number 1. Precious metals. What if I told you that you could protect your money from inflation, currency devaluation, and economic crises by investing in one of the oldest and most trusted assets in the world? Sounds appealing, right? Well, it's true. It's called precious metals, and it's one of the best ways to create sustainable wealth. But don't just take my word for it. Let me show you some numbers. According to the World Gold Council, gold has increased its value by more than 500% in the last 20 years. That means that if you had invested $10,000 in gold in 2000, you would have had $50,000 by 2020. That's an impressive return, right? But wait, there's more. Some precious metals have performed even better than gold. For example, if you had invested $10,000 in palladium in 2000, you would have had $250,000 by 2020. That's a staggering 2,500 times return on your investment. Now that's unbelievable, right? But it's true. And it's not an isolated case. There are many other examples of precious metals that have made investors rich over time. So what does this mean for you? It means that precious metals are a proven and powerful way to grow your money and achieve financial freedom. Precious metals are rare and valuable metals that have high economic value and industrial use. The most common precious metals are gold, silver, platinum, and palladium. Precious metals are a unique asset class because they have several advantages over other types of investments. Some of these advantages are: precious metals can preserve your purchasing power and hedge against inflation, currency devaluation, and economic crises. This is because precious metals have a limited supply and a high demand, which makes them retain or increase their value over time. Precious metals can diversify your portfolio and reduce your risk by having a low or negative correlation with other assets, such as stocks, bonds, or real estate. This means that precious metals can perform well when other assets are performing poorly. Precious metals can offer liquidity, which means you can buy or sell them easily and quickly. You can also store them physically or digitally, depending on your preference and convenience. But how does it work? And what are the risks and rewards involved? Let me tell you about one of the most successful and famous precious metals investors in the world, Eric Sprott. Eric Sprott is the founder and chairman of Sprott Inc., a company that provides investment management and wealth services to investors who are interested in precious metals and other alternative assets. He is also one of the richest people in Canada, with a net worth of over $1 billion. But before he became a precious metals guru, Eric Sprott was a chartered accountant who worked for a consulting firm. He started investing in the stock market in the 1970s, when he discovered his passion and talent for picking winning stocks. He soon realized that he could make more money by managing his own fund than by working for someone else. He founded Sprott Securities in 1981, which later became Sprott Asset Management in 2001. He focused on investing in small-cap companies, especially in the natural resources sector. He had a knack for finding undervalued and overlooked gems that had huge potential. He also developed a keen interest in precious metals, especially gold and silver. He believed that precious metals were the ultimate store of value and hedge against inflation, currency devaluation, and economic crises. He started buying physical precious metals and mining stocks in the early 2000s, when gold was trading at around $300 per ounce and silver was trading at around $5 per ounce. He also launched several funds and trusts that specialized in precious metals investing, such as the Sprott Physical Gold Trust and the Sprott Physical Silver Trust. He was one of the few investors who predicted and profited from the financial crisis of 2008, when gold and silver prices soared to record highs. He also predicted and profited from the bull market of 2010 to 2011, when gold reached over $1,900 per ounce and silver reached over $40 per ounce. He continued to invest in precious metals and mining companies throughout the years, even when the prices were falling or stagnant. He also supported and mentored many junior mining companies and entrepreneurs who were exploring and developing new projects. He also shared his wisdom and insights with his clients and the public through his newsletters, interviews, and books. He became known for his bold and contrarian views, his long-term vision, and his philanthropy. Eric Sprott's story shows how precious metals investing can be a powerful way to create sustainable wealth by following your passion and intuition. He has not only built a fortune for himself and his clients, but also contributed to the society by supporting the development and innovation of the precious metals industry. Number 2. Venture capital. Imagine being part of the next big thing. Imagine having a passion for innovation and entrepreneurship. Imagine having the capital and the risk appetite to invest in high-growth startups. Sounds exciting, right? Well, that's what being a venture capitalist is all about. A venture capitalist, VC, is an investor who provides funding to young companies with high potential in exchange for equity. VCs typically invest in startups that have a strong management team, a large market opportunity, and a unique product or service with a competitive edge. But why would you want to be a VC? Well, there are many benefits to being a VC, both for yourself and for the world. As a VC, you can create sustainable wealth for yourself and your partners. You can also contribute to the economy by supporting innovation and job creation. Some of the most successful companies in the world, such as Amazon, Apple, Facebook, and Google, were backed by VCs in their early stages. But don't take my word for it. Let me tell you about one of the most influential and respected VCs in the world, Marc Andreessen. Marc Andreessen is the co-founder and general partner of Andreessen Horowitz, a VC firm that has invested in some of the most iconic companies of our time, such as Airbnb, Facebook, Instagram, Lyft, Pinterest, Slack, and Twitter. But before he became a VC, Marc was an entrepreneur himself. He was the co-creator of Mosaic, the first widely used web browser, and the co-founder of Netscape, the company that popularized the internet in the 1990s. Marc's journey as a VC began in 2005, when he joined as a board member of Opsware, a software company that he had co-founded and sold to Hewlett-Packard, HP, for $1.6 billion. There, he met Ben Horowitz, another co-founder of Opsware and his future partner. Together, they decided to start their own VC firm in 2009, with a vision to back the next generation of entrepreneurs who are building the future of technology. Since then, Andreessen Horowitz has become one of the most successful and influential VC firms in the world, with over $18 billion in assets under management and more than 200 portfolio companies. Marc's story shows how being a VC can be rewarding and fulfilling. He has not only created wealth for himself and his partners, but also for the entrepreneurs he has backed and the society he has impacted. Number 3. Real estate. A realm that has laid the foundation for countless fortune throughout history. What if I told you that you could build a fortune by investing in one of the oldest and most reliable assets in the world? Sounds tempting, right? Well, it's true. It's called real estate, and it's one of the best ways to create sustainable wealth. But don't just take my word for it. Let me show you some numbers. According to Forbes, 10% of the world's billionaires made their money from real estate. That's more than any other industry, except finance and technology. So what does this mean for you? It means that real estate is a proven and powerful way to grow your money and achieve financial freedom. Real estate is the property that consists of land and the buildings on it, along with its natural resources. Real estate can be used for various purposes, such as residential, commercial, industrial, or agricultural. Real estate is a valuable asset because it has several advantages over other types of investments. Some of these advantages are: real estate can generate passive income from rents, leases, or dividends. Real estate can appreciate in value over time due to inflation, demand, or improvements. Real estate can provide tax benefits such as deductions, depreciation, or exemptions. Real estate can offer leverage, which means you can use borrowed money to buy more property and increase your returns. Let me tell you about one of the most successful and famous real estate investors in the world, Barbara Corcoran. Barbara Corcoran is the founder of the Corcoran Group, a real estate brokerage that sold over $5 billion worth of properties in 2001. She is also a star of the TV show Shark Tank, where she invests in entrepreneurs and startups. But before she became a real estate mogul, Barbara was a waitress with no college degree and no money. She had tried 22 different jobs by the time she was 23, but none of them satisfied her. One day, she met a man named Ramon Simone, who was a diner customer and a real estate agent. He offered her a loan of $1,000 to start her own real estate business. He also became her boyfriend and business partner. Barbara accepted the offer and started her company with a tiny office and a single secretary. She worked hard to find and sell properties in New York City. She used her charisma, creativity, and courage to stand out from the competition. She also used some unconventional marketing techniques, such as creating themed reports, staging apartments, and using celebrities as clients. She was able to attract media attention and generate buzz for her brand. Within a few years, Barbara grew her company to one of the largest and most respected real estate firms in the city. She had hundreds of agents working for her and thousands of clients trusting her. However, things took a turn for the worse when Ramon left her for another woman and told her he wanted his share of the business back. Barbara was devastated and heartbroken. She felt like giving up. But instead of quitting, she decided to fight back. She used the $1,000 that Ramon had given her as a loan to buy him out of the business. She also used his betrayal as a motivation to work harder and smarter. She continued to expand her company and dominate the market. She also diversified her portfolio by investing in other types of properties, such as hotels, resorts, and condos. In 2001, she sold her company to NRD Incorporated for $66 million. She then became a TV personality, an author, a speaker, and an angel investor. Barbara's story shows how real estate investing can be a powerful way to create sustainable wealth by overcoming challenges and seizing opportunities. She has not only built a fortune for herself and her family, but also inspired millions of people with her story. So, whether you're a dreamer, a doer, or a bit of both, real estate has a path for you. And who knows, your story might just be the next epic tale of real estate triumph. Number 4. Stocks. What if I told you that you could turn $10,000 into $1 million by investing in the stock market? Sounds unbelievable, right? Well, it's not. It's possible. And it's easier than you think. But don't just take my word for it. Let me show you some numbers. According to a study by NYU Stern School of Business, the average annual return of the U.S. stock market from 1928 to 2020 was 9.7%. That means that if you had invested $10,000 in the stock market in 1928 and reinvested all the dividends, you would have had $1 million by 2020. That's an amazing return, right? But wait, there's more. Some stocks have performed even better than the market average. For example, if you had invested $10,000 in Amazon in 1997, when it went public, you would have had $21 million by 2020. That's a whopping 2,100 times return on your investment. Now that's unbelievable, right? But it's true. And it's not an isolated case. There are many other examples of stocks that have made investors rich over time. So what does this mean for you? It means that stocks are one of the most powerful and profitable ways to invest your money and achieve financial freedom. Stocks are shares of ownership in a company that are traded on a stock exchange. Stocks can increase or decrease in value depending on the performance and prospects of the company and the market conditions. Stocks are one of the most popular and profitable ways to invest your money. Stocks have several advantages over other types of investments. Some of these advantages are: stocks can generate income from dividends, which are payments made by the company to its shareholders. Stocks can appreciate in value over time due to the growth and innovation of the company and the industry. Stocks can offer liquidity, which means you can buy or sell them easily and quickly. Stocks can diversify your portfolio and reduce your risk by investing in different companies, sectors, or markets. But how does it work? And what are the risks and rewards involved? Let me tell you about Warren Buffett, one of the most successful and famous stock investors the world has ever known. Warren Buffett is the chairman and CEO of Berkshire Hathaway, a holding company that has interests in various businesses such as Geico, Coca-Cola, Apple, and Amazon. He is also one of the richest people in the world, with a net worth of over $100 billion. But before he became a stock market legend, Warren Buffett was a young boy with a passion for numbers and business. He started investing at the age of 11 when he bought 6 shares of Citi's Service Preferred for $38 each. He also sold newspapers, magazines, and gum to earn extra money. He continued to invest and save throughout his school and college years. He learned from various mentors, such as Benjamin Graham, the father of value investing. He also developed his own investment philosophy, which focused on buying undervalued and high-quality companies with strong competitive advantages. He started his own partnership in 1956, with $100,000 from 7 investors. He managed the fund for 13 years, achieving an average annual return of 29.5%. He then merged his partnership with Berkshire Hathaway, a textile company that he had bought a controlling stake in. He transformed Berkshire Hathaway from a struggling business into a powerhouse of value creation. He acquired and invested in dozens of companies across different industries and sectors. He also partnered with other brilliant investors and managers, such as Charlie Munger, his longtime friend and vice chairman. He followed a simple but effective strategy: buy great businesses at fair prices and hold them forever. He avoided speculation, leverage, and diversification. He focused on long-term results rather than short-term fluctuations. He also shared his wisdom and insights with his shareholders and the public through his annual letters, interviews, and books. He became known for his wit, humor, and humility. Warren Buffett's story shows how stock investing can be a powerful way to create sustainable wealth by following sound principles and practices. He has not only built a fortune for himself and his shareholders, but also inspired millions of people with his story. Number 5. Peer-to-peer lending. What if I told you that you could earn up to 10% interest on your money by lending it to other people online? It sounds too good to be true, right? Well, it's true. It's called peer-to-peer lending, and it's one of the fastest growing and most innovative ways to invest your money. But don't just take my word for it. Let me explain to you how it works. Peer-to-peer lending, P2P, is a type of financial technology that allows individuals to lend or borrow money from one another without the use of a bank. P2P lending websites connect borrowers directly to lenders. The site sets the rates and terms and enables the transactions. P2P lending is a win-win situation for both parties. Borrowers can get access to lower interest rates and faster funding than with traditional loans. Lenders can earn higher returns on their cash savings than they would get from a bank account or a certificate of deposit. But how does it work? And what are the risks and rewards involved? Let me tell you a story of one of my friends, David, who tried P2P lending and changed his life. David, a 35-year-old engineer who lives in California. David has always been interested in investing and finding new ways to grow his money. He has tried stocks, bonds, mutual funds, and even cryptocurrencies, but he was not satisfied with the returns or the risks involved. One day, he came across an article about peer-to-peer lending and how it can offer higher returns than traditional investments. He was intrigued by the idea of lending money to other people online and earning interest from them. He decided to give it a shot and opened an account with Lending Club, one of the largest and oldest peer-to-peer lending platforms in the United States. David started with a small amount of $1,000 and invested it in 40 different loans, each with $25. He chose loans with different risk ratings, interest rates, and loan terms. He wanted to diversify his portfolio and reduce his exposure to defaults. After a few months, David was happy with the results. He was receiving monthly payments from the borrowers that included principal and interest. His annualized return was around 8%, which was much higher than his bank account or his stock portfolio. He decided to reinvest his earnings and increase his investment amount. Over the next 5 years, David continued to invest in P2P loans and grew his portfolio to over $50,000. He also learned how to use automated tools and algorithms to help him find the best loans and optimize his returns. He was able to achieve an average annual return of 10%, which was more than he had ever expected. David's story shows how P2P lending can be a great way to create sustainable wealth by doing something simple and rewarding. He has not only earned passive income from his investments, but also helped other people achieve their financial goals.